The news that you've heard about the sell off in the market that we've been seeing in recent days is likely alarming if you've been paying attention. So, I wanted to address what's happening and also let you know that this is certainly not a reason to panic for most people or to make major changes to your investment strategy at this time. I'm Valerie Leonard, CEO of EverThrive Financial Group, and here's four things that you need to know when thinking about your money in light of the market volatility that we're seeing. First of all, this selling frenzy is completely normal by historical standards at this point. Most investors aren't aware that market corrections happen almost every single year. The majority of market indexes fall between 5 and 10% at some point within each calendar year, typically, and the average time to recovery takes only about 1 month. You may remember in my last video that I mentioned we hadn't seen a sell off of more than 2% in the market in any given day at any point this year. However, we're all old enough to remember last year, and then some of us are old enough to remember the past few decades where 2% moves in the stock market in any given day were considered normal. So having said that, yesterday the S&P 500 sold off 3%. Yes, that sounds extreme, but it's not necessarily abnormal. And then in terms of the longer run, the index is down about 8.5% as of the close of business yesterday since the beginning of the year. But it is still up roughly 8.6% since January 1st. So things aren't as bad as the media may have you believe. Second of all, there are a few things driving this sell off, but it's important to remember that volatility like this and market corrections don't just happen overnight. They happen because uncertainty starts to creep in. So in this case, we've had a highly concentrated group of stocks that have posted major gains in short periods of time, relatively speaking. And those stocks often make up substantial portions of investors' portfolios in many cases. And so when these investors see big losses in those handful of stocks, they tend to panic sell, and then that can drive prices down further and faster. But history teaches us that emotional investors tend to overdo it. And then once the market catches its breath, you'll often see large amounts of money enter the market and then drive it back up, often quickly. And then also, investors are moving away from what we call mega cap stocks. These are companies that are so big, investors have seemed to think that these companies could do no wrong because often they're household names, or maybe they have exposure to opportunistic type products or services like maybe AI or crypto. Those are big buzzwords right now, right? And then another thing driving the sell off is a sudden interest rate hike from the Bank of Japan. The yen, Japan's currency, has been cheap compared to the US dollar. And big hedge funds have borrowed it to basically buy mega cap stocks like Apple, Google, Microsoft, Tesla, Amazon, Nvidia, and Meta. But unfortunately, when the yen started moving higher, that started working against traders, and then they were forced to sell these stocks. So then last week, we had a weak report on the jobs front that led many folks to believe the economy was slowing quickly, more quickly than they expected. So this, along with basically everything else, spooked investors who weren't already expecting this economic slowdown. And then last but not least, you have to understand how markets and brokerage firms operate in order to understand that oftentimes big funds or even traders with large amounts of capital can be forced to sell when markets move down too quickly. They may be forced to dump stocks that they don't actually want to unload simply because their management team tells them that they need to take risk off the table. So these guys can move markets in big ways and also fast. And in the end, this de-risking process can lead to wider swings in the market in shorter periods of time. Now, third of all, we're seeing a shift in economic and market conditions and also market leaders, but that doesn't mean that the market is crashing. So for clients who have worked with me for a long time, you probably recall the definition of a market crash because I've likely educated you on this point before. When the market sells off by 10%, we call that a market correction. Market corrections on average take only about 4 months to recover. And then when the market sells off by more than 20%, we call that a market crash. We are nowhere near crash conditions as of this morning. But having said that, it takes roughly 14 months to recover from crashes from a historical perspective. And so while I don't think we'll likely see a crash this time around, 14 months is still a relatively short period of time, even for retirees who statistically will live several decades into retirement and don't need all of their money all at once. So unless your investment time frame is short, these types of events can actually potentially lead to great buying opportunities for investors who have patience. Fourth of all, panic is not a process. Let me say that again. Panic isn't a process. And when it comes to successful investment strategies, having a discipline or having a process is crucial. Making decisions based on emotion or the latest sensational news the media is selling can mean substantial long term consequences and significant underperformance for investors. A better strategy, in my opinion, is to invest with your comfort level in mind to begin with, and then stick to that strategy when markets pull back, correct, or even crash. Market pullbacks can be a reminder of the importance of regularly keeping tabs on where you are, how your investments are allocated when you open up the hood and you look underneath the surface, and then what options are best for you in any market environment. Investors who panic in times like these tend to fare worse over the long run than investors who are focused more on the long run instead of trying to time the market. So, for our clients who have chosen to partner with EverThrive Financial Group for investment management services, first of all, thank you. But know that we are watching things closely and we will react on your behalf if necessary, based on our knowledge of your personal financial situation, your risk tolerance, and your needs. And if you're a participant in a retirement plan managed by EverThrive, the best strategy is probably to review where you are from a risk perspective and make sure that your investments are actually in line with your risk tolerance. If you need help doing this, we can certainly assist you. So just reach out. And then for anyone else out there who's nervous and isn't working with an investment advisor, we're happy to take a look at your investments and offer advice. Please just reach out if you have questions or you want to learn more about how we can help you make confident decisions about your money. For more updates, click subscribe to our YouTube channel and you'll receive notifications each time we post new content. Thank you for your time today, and I will see you again soon.